Let's talk a little bit about the first part of that sentence, which is the importance of U.S. and global equities in Japanese portfolios. Tell us a little bit about what sort of trends you're seeing this year. We know that this is an annual conference, your 16th so far.
It is. It's fantastic to be back in Tokyo. And as you said, this is our 16th year, and this is our biggest in terms of attendees and people who've signed up. So I think the interest level, both investing in Japan, but also Japanese investors, as you said, to look elsewhere for international investments. We've noticed, for example, in our S&P World Index over the last decade, the weighting of U.S. equities has grown from less than 50% of a world index to now 60%. So the concentration that we've heard about, but also the demand for U.S. equities has grown pretty substantially. And we're seeing that demand here in Japan.
Of course, a lot of that is to do with the tech behemoths,
yes,
right? And that concentration. So I guess it's really important more than ever for diversification in this story. So how does Japan play into that?
Well, Japan, through the market reforms that started, 7, 8 years ago, which have moved forward now with changes in monetary policy. You've seen wage growth, more recently. So there's an optimism over the medium term for investing in Japan. And we've seen flows come here. And then domestically, you've seen significant reform for savers. The NISA plan, the Nippon Investment Savings Accounts, have grown and expanded. So I think both for domestic investors, but also for international, Japan is really top of many investors' lists right now.
We hear a lot of optimism when it comes to Japanese assets, especially when you're thinking about comparing it, say, perhaps with China, and then that diversification away from what's happening there. But at the same time, when it comes to the Japanese economy, there's a little bit of skepticism, I feel, now that I'm in Tokyo, about where the economy is headed from here, as Japanese people are having a harder time with a cheaper yen and higher costs of living. Are you seeing that divergence, and does that matter to investors who are looking globally on where to put their assets?
It does. I think the domestic economy, as you mentioned, seemed to be pulling out of the long-term deflationary trends. Obviously, more optimism to start the year, but then we've seen a little bit of a slowdown in the last couple of months. But I would say for Japanese companies, and you think about investing in equity prices, again, the reforms on governance that have been done. Also, many manufacturers in Japan have now offshored operations, so the currency is less of an impact for them, for example. So I think you've really now seen that, in addition to more confidence with better governance, proxy voting, and a little bit more transparency. And then more recently, you've had the stock exchange and others encouraging Japanese companies to be more efficient, more share buybacks, more consistent dividend policy. So returning capital to shareholders, who are more accustomed to that, say, for example, in the United States.
Dan, of course, some of the interest in these darling markets of Japan and India has come at the expense of China, right? I'm wondering, what are you hearing in terms of the interest and the potential flows into investors wanting some sort of exposure to China despite its ongoing troubles?
Yeah, we are seeing, obviously, there's been a rally this year, particularly in China, but we're seeing investors really searching kind of globally for diversification. As I mentioned earlier, there's been a very large concentration, these magnificent 7 names and indices like the S&P 500, which we have. So investors are looking for diversifying emerging markets, valuation-wise, tend to be more attractive in some cases. But right now, we continue to see the momentum focused on, for example, in the U.S., the Federal Reserve policy. And again, from an earnings perspective, you continue to see the large technology names, themes like generative AI, continue to dominate marketplaces. But I think those investors who can take perhaps more of a medium to longer term view are looking for emerging and other markets where perhaps valuations are more attractive.
What's next in terms of the strategy in the business, perhaps beyond core equity indices?
Yeah, well, S&P Global, who owns S&P Dow Jones Indices, purchased IHS Markit back in 2022, and that gave S&P Dow Jones Indices fixed income capabilities, so market-leading opportunities in credit, both investment grade as well as high yield, and particularly using that in certain customer segments like insurance, for example, which is a very important segment for us. Insurers now using instruments like ETFs more in their general accounts, And then also with higher interest rates in many parts of the world, being able to now use indices more in fixed annuities for the first time really in decade plus. So really starting to see the benefits, particularly of that merger, but offering multiple asset classes together for diversification benefits.
And Dan, of course, we know the Japanese pensions are huge market makers here across the world. What can you tell us in terms of your business partnerships and collaborations with asset managers locally?
Yeah, well, it really started with our partnership with JPX over 20 years ago. And then locally, we had a significant partnership start with GPIF, the world's largest pension fund and sovereign wealth fund, back in 2018, where we partnered on carbon efficient indices. So really bringing more of the sustainability story to this marketplace. And that partnership has grown. We've also, as you said, been able to then also leverage many of the local asset managers, brokerage houses in building local products. But particularly, they want to bring, say, the S&P 500 and different versions of that. So dividend-enhanced strategies have been very popular, with a stronger dollar as well, but also areas to diversify, like fixed income that we talked about. So I think the partnership is growing, but we're starting to see more demand, particularly as more even retail investors through the NISA programs are moving out of traditional, savings accounts now into investment portfolios. It's exciting.